now I'm going to turn this over to Jonathan. Jonathan had a 13-year career at Procter and Gamble on the product side, and and then I'm going to be curious to find out what drove you into Stanford. You're a Stanford graduate, graduated in 2017, and since his graduation, he's been focused on orphaned ventures. And I'm just so excited to have you here, Jonathan. Thank you so much for sharing your knowledge about this.
Well, thank you so much for the invitation, Karen. Am borderline a search funder myself, as I would say that many of the investors would look at my thesis as very outside of traditional search, but I've got a great amount of respect and admiration for the search funder community. And in many ways, what I do is very similar to that, just under a very different class of company. So a little bit of background about myself. I eventually had call it the entrepreneurial itch after a long corporate career and decided to go off and start my first business a number of years ago. I made a lot of the similar rookie first-time founder mistakes that many other founders in my position that have no right to raise the capital that they did go through. And in effect, what I do now is in some ways a way to try and make amends for sins of my own founder past by looking for businesses that had perhaps a great concept or a great product behind it, but suffered from some execution issues. And how I got into this is a couple years ago, I co-founded another firm called Wheelhouse Partners that was going under this same thesis of venture-backed businesses that are left behind by venture, and it's sometimes called the zombies, the walking dead of the venture industry. And I really started exploring what happens to these businesses. And that's really how I got into what I've been doing now for about four and a half years. About a year ago, I co-founded a new firm called Transformation Equity Partners that follows this same thesis. And this is a topic that's near and dear to my heart, and I'm appreciative of the chance to be able to share some of it with the search funder community, and hopefully some of it's of interest to you as well. So I'll start this here with just a simple background around the way that venture works and what's a little bit different about venture capital versus traditional private equity, of which I would consider Searchfund to be a part of, and can really explain it with just two charts here. What you have on the left is a normal distribution versus an exponential distribution. And most everything in this world, I'm going to very broadly generalize, can fall under one of these two distributions. What's most important is really to understand when one applies versus the other. So for instance, a normal distribution will apply to things that tend to be averages or on a macro level. So the height of world population will follow a distribution like this, or even in an organization that's very large, that like General Electric, that really popularized the ABC approach, will have employee ratings follow also a forced bell curve distribution. And athletes, their success tends to also follow a distribution. If you look at things like free throw percentage or field goal percentage. I can go to the next slide. Now, what's impactful is if you look at what is the difference between an exponential distribution, it tends to come from things much more on a micro level. And one way to look at it is the impact of the averages. So while the height of the world population may follow a distribution like this, the number of people or the impact of a few individuals tends to be much more on the aggregate side, on the far exponential side. Or proportionally as well, if you look at what is very common within a company, for example, of 100 employees, it's not at all uncommon that 2 or 3 of them are really the stars that drive the majority of returns. And if you look at it at an average level, you may actually see this bell curve distribution. But the impact tends to be much more exponential. So go one more slide. So why does this matter here? The reason why it matters is it's important to know when a normal distribution applies and when an exponential distribution applies. As an example that I think is relevant to many people on this call here, the number of LPs or potential LPs that might take a meeting with you or subsequently fund your investment, they're likely going to follow more of a Gaussian distribution. But each of those individual LPs that funds are probably not going to. They're likely going to follow more the extreme at a micro level, that maybe 1 or 2 of them will give you that $3 or $5 million check, or be a significant percentage of their capital base, versus the hundreds you've spoken to and the 20 or 30% that may return your calls. And also, of course, important to recognize is that, these two also rarely correlate. I can look at the height of the world population, and while I wish I was taller and made more money as a result of being taller, it's very hard to pinpoint a person who's exactly 5'8" versus 6'5" and say that that person is going to make more money than the other, or that NBA player that has a higher free throw percentage is going to make more money. But that some of them will. So why am I talking about this, and why does this apply? Because we oftentimes within the investment world look at companies and believe that they fall within a normal distribution. And particularly within the world of venture capital, they do not. They follow very much an exponential distribution. So let's go to the next slide here. Those two slides I want you to keep in mind, or those two charts I want you to keep in mind as we go through the last slide here. At a macro level of returns, something that I found very interesting a couple of years ago when I first saw this. This is some data from PitchBook that's here, and this shows the 10-year average return across a variety of different investment fund types. And it shows 10 years as being approximately the average life cycle for an investment fund. And the thing that was really shocking to me is that it's approximately equal for every investment strategy, no matter where you invest. Now, of course, there's going to be some pros and cons to each. Debt is going to be the one that's a little bit lower because they give you some downside protection as a secured interest against loss. Fund to fund has the advantage of being passive and thus requires lower operational intensity and perhaps some lower litigation risk, but tends to require higher capital, and public equities being the most liquid. But perhaps contrary to the purposely controversial title of this talk here, this would just suggest that there actually is no arbitrage out there. No matter how you choose to invest, returns are always going to be all around the same. Good. Go to the next slide. And that may be the case until you start looking at the extremes at the micro level, if you dive in from the macro. And specifically, if you look at venture capital, where I'm closest to, these are some charts from Andreessen Horowitz, one of the top VC firms. There's a little bit of a translation here between IRR and multiple, but effectively, if you look at the chart on the left here, it shows that the best performing funds, or really any fund that actually returns positive capital, needs to have an investment or two that is a 10x, and in many cases, they're the 100x or the 15x, or 500x. And in some cases, the very successful ones have had as much as 15% of their portfolio be really these 10x winners. Now let's compare that versus the chart on the right that shows that how many investments a VC will make that fails. And you can see that even in the successful funds, more than half of investments will fail. Now let's try and mix the micro together with the macro. Let's go back to the next slide. If we compare this together and we look at venture capital as providing on average about the same as every other investment class, about 13% on a 10-year standpoint, which is a little bit more than 3x, it's like 3.4x returns. How do you comprise that 13%? Well, here you look at this and you can see that about 2/3 of all the value that gets delivered from venture comes from, or I'm sorry, about 2/3 of venture firms actually lose money. Only about 1/4 of them actually will deliver positive returns on the order of at least 11%, which is that 3x threshold. And let's compare that versus, I think it was the 2020 Stanford Search Fund study that showed that only about 25% of searchers will lose capital and more than 50% will deliver 3x returns. And I can look at that and think, why would anyone ever want to invest in venture? And the obvious reason is because of those extremes on the far right side of the exponential distribution. Those 26% of firms are not just delivering 11%. It's more like 1 or 2% will deliver 500x. Another 2 or 3% might deliver 50x. And that average really gets skewed because of the extremes, which means that among this investment class, it's really great if you've invested in a firm that's delivering 500x returns, and terrible if you've invested in any of the others. Okay. So this is, I think, my last slide here, where you're going to see where that exponential distribution also falls in place. And this very much falls in place in terms of the returns from, I would actually venture to say, not just VC-backed companies, but really all companies. Just the size of the y-axis may be a little bit lower. But here you can very clearly see across every company funded by venture for about the past 10 years that's here, more than 2/3 of that value is coming from a small percentage of companies. This data I put together about a year ago, so it's actually gone higher as the market went even crazier during COVID. And I think it's even more extreme now. But those companies on the far right hand are all the really buzzy ones that we hear about, Uber, Stripe, the Gong.ios of the world. Next to them, you'll see another category of companies that may not get as much publicity, but do great. I mean, each one of those companies are also going to deliver in the 5, 10x, if not more. And of course, I think as most people understand, because of all the risk that goes into venture, more than half of the companies will fail. Those are the ones that never achieve product market fit. And then stuck in the middle in the second quartile there's approximately a third of venture-backed businesses that just get stranded. And these are the companies that I target with my thesis, what I call as companies that get orphaned by venture. And I purposely use that term because it's really nobody's fault that they're there. This is just an inevitable part of the capital journey where any company that is trying to do something impactful is going to take on risk. And an investor needs to have that level of risk to go into them. Many of these companies here may never achieve product market fit and may be doomed for failure eventually. Some of them may just be too nichey that the market may not be big enough or grow fast enough in order to provide 10x returns. 2x returns may sound great to us, or 3x returns sound great, but for a venture investor that's really relying upon 1 or 2 hits of 50 to 100x, it's not worth their time to be able to spend it on a 2 or 3x. In fact, it's much more in their interest to try and take a 2 to 3x company and push it to be 100x. And if it fails, well, it's another at bat where you get a chance for a home run. And naturally, I think is a little bit of a combination between all of this. Many of those second tier orphans have also suffered from execution issues. And that I also certainly don't want to fault anybody for. It's very difficult to be a founder that can create something from nothing and then become a founder that's created a business with one customer and be able to hire 10 employees and then grow from 10 to 100 and then eventually become a publicly traded CEO. Very, very few people have that skill set that they can do all of it. And oftentimes it requires a bit of staging along the way. So if you don't find yourself to be lucky enough, or if you're a founder that hasn't found yourself to be lucky enough to be either with the right market dynamics or perhaps just didn't get the right customer at the right time, you can very easily find yourself stranded here. And it does not mean that you have a bad company by any means. It just means that you are not right for the venture investment returns model. And those companies that are not right, that still leave some value on the table, are exactly the ones that I go after. And personally, I think would actually be very well suited for the majority of people that choose to do a search fund because a search fund is so operationally intensive rather than being investment intensive. And these businesses really fundamentally just need some key blocking and tackling in terms of operational leadership. As I said, that these are companies that are probably more at the 50 to 100 employee scale. I have already well established beyond the startup stage. And that requires a very different skill set versus the product discovery and the product creation to go to organizational scale and leadership. So kind of last thing that I might just close on here is that part of why I think this is really ideal for somebody that has a strong operational background is, there is no such thing as risk-free within the investment world. There's just the type of risk that you have. And I certainly don't want to give the impression that I think this is a lower risk. People oftentimes that I will speak to will say that you're doing a deep type of value investing. And I really don't like that term because there's no investor out there that doesn't think that they're investing in value. Now, anybody that would have invested in Coinbase last week, even though their multiple is insane, like they're 10x the value of NASDAQ, nobody invested because they thought it was a crappy value. They invested because they think that it's a high price that's going to get even higher. The only difference between what I'm doing is really from a standpoint that I tend to be able to get into businesses at a much lower valuation, but they're still laden with risk. It's just a type of risk that I tend to be better at, which is operational risk. Venture, of course, venture capital likes to look more at market risk where there's greater returns and also a greater probability of failure. And traditional PE, I would say, it looks at more like things of valuation risk. So if you are well suited at operations, I think this tends to be a pretty good model for the skill set match that you need. Okay, I think I've probably surpassed my 10 minutes here, Karen, but I'll turn it over to you or anyone else that has questions that they would like to ask.
So you mentioned that having the operational experience would be pretty key in this sector if somebody was interested in it. What other attributes do you think would make somebody successful in considering doing an orphan?
Yeah, I think it's very hard to do this space unless you have some familiarity with venture and the deal terms that tend to be associated with venture. So, for example, I've seen a number of questions that get flagged within Searchfunder about things like seller's notes, which I'd honestly never heard of until I encountered this community. And I know it is fairly common within the world of buyouts. Buyouts can be pretty tricky when you're dealing with a venture-backed business that has multiple rounds of funding with different preference stacks and different rights per share class. So a familiarity, and if you don't want to spend a lot of money on legal, which can become pretty onerous with some of the contracts and the purchase agreements to go through, having some familiarity with deal terms and watchouts is a very critical one for being able to, of course, get the deal done. And then being able to identify a deal like this also. There really is not a great way of doing so other than just having an expansive network that goes across those that play within the venture ecosystem and have an incentive in it.
So you've raised a couple of different things that I kind of want to dive more deeply into, because I can imagine someone, if I were VC backed and no longer backed, I might have still a pretty high opinion of myself. So how do you navigate the seller view of their valuation relative to where they really are at?
Yeah, great question. And that is spot on. One of the top challenges in trying to get a deal done, and even in trying to manage the culture that's been left behind. Because simply on any of the employees that joined a venture-backed business, they tend to join because they want to be on the rocket ship. They want to be on this great, sexy company that's growing 100x per year. And if it's not the case, inherently, not just the CEO and the leadership team, but even every employee tends to have a very high opinion about the skills that they could be taking elsewhere. So I'm going to bifurcate your question in two. The first part about the seller opinion, the advantage of this approach here is that you don't have a single seller. The disadvantage is you also don't have a single seller. So there's not a single person that I negotiate with to try and figure out the best deal terms that are in place. It's a board of directors that's responsible for the governance of the company, and a board that is purposely separated from operations. They are oftentimes the investors, or in some cases, some of the early advisors that were brought on and compensated in order to help to govern this business. And you don't always need to get all of them. In fact, rarely will you get all of them. What you do need is to surpass within the certificate of incorporation of the company what's required in terms of majority in order to get agreement to doing oftentimes not a buyout, but a different financing round that would be a down round that can give you all the benefits of buyout, meaning majority control. So, and that can be harder and easier. It means you've got more people, more coalitions to try and convince. And even if you are successful in convincing it, it doesn't come without legal risks, because any shareholder that does have a say, although not the ability to veto such a transaction, does unfortunately have the rights, or I don't know about the right, but given the litigious nature of our country, they can always come back and make an assertion about a lack of fiduciary duty, or any bevy of excuses for why they might want to try and litigate, which can be painful.
So let's talk about, you mentioned the deal sourcing side, and you're saying it's really about the network that somebody has. Are there other established venues, or is it truly just the networking?
I think the network is, and I think many searchers may find this, the best deals you'll find, or perhaps the most profound, will tend to come from network. About a year and a half ago, I wrote a script that crawls the web for a number of different media sources in order to identify what are the leading characteristics of a company that is subject to be orphaned. And these are pretty basic things. I've received a funding amount around about 18 to 24 months ago, have received the debt funding in between, have a valuation between X and Y, have a certain employee count that's I can quantify based upon a number of people on LinkedIn, a number of job posts on LinkedIn. There's a number of leading indicators that are very consistent about when a company will no longer be a fit within a venture portfolio. And I have to say that that script that I put together has resulted in zero deal flow for me. It's only served really as some confirmation bias of when I do access my network and recognize, okay, yeah, company X, that was on my list, but I've never been able to actually successfully have that identification turn into a deal. I think it's because there's such a human nature of this when you have so many different stakeholders in place here that a company that might be in a position that they could be acquired for a discount or undergoing a restructuring that could be suitable. They may not be in the ownership position where they may not be willing to let go. So I've never found a better source than just a network of either entrepreneurs or oftentimes the lenders that have a senior interest that's been secured in the actual terms. I very rarely will ever be able to find a successful acquisition source coming from the investors themselves.
So, if I were someone who was just starting out in the space, I've got some interest in it. Is there any sort resource that I could look at to learn more, or someplace to go? And I'm just thinking about the fact that some universities now offer classes on ETA and on search funds generally. Is there any other source that I might be able to go to learn more?
Yeah, there's a small group of, I want to say about 10 to 15 funds or individuals similar to myself that do this really across the globe. And if you look in the right places, you actually, if you go to my fund's website in the media section, I try to do as good of a job as I can highlighting and aggregating all different sources that are related to this hole within the venture market. And I also hesitate to call it a hole because it's that implies that venture is doing something wrong. Like this is exactly the way venture is supposed to work. It's naturally, if you're going to take some risks, you're going to leave some businesses behind here. But for those that are actually purposely targeting, there are some fairly prolific writers out there about this topic. So that's one place that you can look. There's a number of research papers that go back many years. In fact, actually, the first instance I saw about this was a paper written by the chief economist of Chase Bank in 1950. But it tends to be a pretty sparse source given how few players there are out there.
Thank you. And you mentioned that in some ways you're sort of making up for mistakes that you had in running businesses before, I think is what you mentioned. And how do you feel like you're making up for those mistakes?
By trying to give some life back to a good business that was that failed because of execution issues. So in just a little more detail, I mean, I had raised money from some of the wrong people, raised way more money than I was really should have been able to raise. And simply just by lack of experience is how I found myself in some old hot water. Now, I think that also keys towards what makes somebody suitable towards this type of a model. It requires a pretty heavy amount of restructuring as well as organizational and operational leadership because you are going in, like any search, into a new company where you're injecting new DNA into the organization. But perhaps a little bit different than traditional search is you don't have an oracle to help guide you through there in the form of the prior founder or the prior owner that's looking for a smooth transition. I mean, almost always the leadership team will require some drastic change, if not replacement altogether. So to institute a completely new culture of financial discipline and organizational structure into a company that's just been on a skyrocket of spend at all costs in order to grow is very difficult.
Yeah, I guess when you have to approach that cultural change, do you start with basically with the leadership and kind of work your way down the management levels?
I guess the easy answer is it depends, and kind of depends upon the dynamics of the company. So, from a couple examples within my past, in dealing with enterprise sales, or an enterprise software business, sales tends to be a very dominant culture within the company. So, for a business like that, that's so heavily dependent upon customer acquisition, I started with sales. Now, for another company that I was involved with that was more among e-commerce, that one is much less driven by sales, but actually much more driven by engineering. So in that case, there I started more with a CTO. But in every case, I think your question is spot on towards really finding who are the key advocates within the company that you're really going to latch onto. So if you have 100 companies, who are the 2 or 3 overperformers that you really need to make sure that that hold on. And ideally, those are also the 2 or 3 that fit within the core competency and the critical areas of the business that you need to retain, but not always. And as a key requirement for this, I think also not unlike a traditional search, is you do need to be prepared with your own bench of talent, if not to go on day one, but to be ready to go in case or for when there is some unwanted attrition.
Wow, I kind of want to ask you about what that day one actually looks like for you, because I have a pretty clear picture after interviewing so many different searchers, right? There's the big announcement. The old owners may kind of celebrate and show the searcher around the building and talk to people and do meetings, and there's always that sort of jockeying between like how long does the old owner stay around, or are they there that day and then gone, or what. But there does feel like that feeling of handing the keys to the car over to someone. What does your day one look like?
Yeah, it's a tougher one, and that jockeying does happen. I mean, in this world, I'm not Blackstone where I go in and I'll try and just carve 40 people or 40% of the organization out by surprise. But inevitably, because of confidentiality, not everybody in the company is going to know what's happening. The leadership team, they obviously they do. When you're going through the diligence process and the deal negotiation, if they don't know what's happening, you haven't done your proper diligence. So it should not be a surprise to anybody on the leadership team, least of all the CEO. Now that day one does require some very careful scripting to plan out, even by the hour, about external official communications going out to customers, to suppliers, to key partners, timed together with internal communication that goes across the company, that then goes in concert with each division, a leader to then meet with our individual teams, and just being very present as the new leader yourself to come in and provide some reassurance that the company is going to be on stable footing. Oftentimes, that's not so much a difficult case for many venture-backed businesses that have been in growth at all costs, that the employees know that the companies just have been burning cash and are in need of a different operational and financial model. But it can be very shocking for somebody that was not expecting to lose their job to then be given notice.
And tell me about the timing of change. So for searchers, they're usually told like, don't make anything major for 90 days to 6 months. A lot of times, what they're spending their initial time on is just getting the books together, right? Because they don't have a lot of small, medium-sized businesses don't have the capacity to do rigorous accounting and bookkeeping and all of that. For an orphan, I'm presuming that because they were reporting to the VCs, they've got their accounts pretty well adjusted. Um, but you can disabuse me of that notion. And so, what is your emphasis in that first period, and the level of change that you would make?
Yeah, I will disavow you of that perception. I think it's becoming a little bit more extreme as of late, because many of the top venture firms out there want to be known as founder friendly. They want to be a place where, if you have a really hot company, they're actually competing for the ability to fund that business. So much more leash is given these days to founders than before. So I would say some of the similar challenges about books not being entirely clean, tends to be very common. And in fact, the two areas that I would say are usually most neglected or most in need of some cleanup tend to be within finance and operations. And I would corollary that with not different from any other search itself, is really do a key job in your due diligence. If you don't necessarily need to know all the answers, but you need to know the right questions. So that cleanup period is going to last for a while. Now, that cleanup period of getting the books in order, getting the right revenue recognition, getting the right organizational structure, that may not need to happen instantaneously, but rather than wait and let the dust settle, which would be a very nice luxury to have, I actually recommend that you get the worst out first and make all of your hard moves within the first week, if possible. If not the first month, there may be some legal and compliance restrictions that prevent you from doing that. But very clear as part of every plan that I have is to set a clear 100 days with week by week, which are the goals for the transition, not even the business, but just for the transition to have been successful. And if you're still making significant changes after 3 months, eventually some of them are going to happen. As a wise philosopher said, everyone has a plan until you get punched in the face, and you will inevitably find a new way to get punched, and in the kidney or in the back. Those will happen, but as best as you can, try and keep as much of the change as drastic as you can, because you're inevitably going to be starting from how do I get to that 100 day with as much recovery of personal capital as possible. So get the worst out first and let that recovery period be as stable as possible.
Wow. Yeah, it sounds like you have to definitely have a strong stomach, which I don't have, for this kind of work that you are doing. I want to make sure that folks know that they can ask questions in the chat or raise their hand and unmute to ask a question of Jonathan. I find really fascinating. Have you noticed any kind of a change based on the pandemic or not in this space?
Yeah, yeah, a dramatic change. In the early days of the pandemic, deal flow really went through the roof. And this is before the Fed started to just print trillions of dollars. But I was seeing even what I would consider to be non-orphan companies, but actually great businesses that are growing and profitable, just suddenly coming out for half the valuation of what they were seeking because liquidity totally dried up. And that window, unfortunately, ended very quickly. I think there's two effects that we're going to see out of this. Number one, deal flow became much more difficult because so many of the stranded businesses found it easier to be able to find capital. Not all of them, I would say. Those that were kind of on the edge, or perhaps among the 1/3 of companies that will find themselves stranded. I don't know what percentage of those are actually really salvageable, or those that I would go after, but the many of those that would have been more salvageable, or those that I would say hit requirements, found the ability to be able to raise elsewhere. And the amount of money that's gone into venture over the past year has just been dramatic, because they've been able to show such high returns. So short term, it has made deal flow much more difficult. Now, the long term, because so much more capital has gone in, naturally there will be more collateral damage that's been created. So there will be more companies that I fully expect in a year or so, after the PPP funding has been forgiven, all the additional stimulus has been cycled through, that are still not to the point of profitability and have not shown their growth targets.
Well, that does sound like there's going to be a lot of opportunity in a year or so for this sector, for anybody who is interested in doing it. I definitely want to thank you, Jonathan, for this wonderful discussion, for opening my eyes to this other aspect of entrepreneurship through acquisition that I knew absolutely nothing about before today. And I'm going to definitely keep an eye on your website and take a look through that to see what folks are talking about. And I hope you keep us posted on your progress as you're doing this, because this sounds like such an exciting area for folks, and for you personally as well.
Great. Well, thank you again for having me on here. Happy to field any more questions if we have time. If not, welcome any folks that do have questions to feel free to reach out and contact me.
We have a rather silent group today. I think it's one of those things where it was just so illuminating and so unique space that I'm not sure. I think folks are just soaking it in at this point.
I see a couple in the Zoom's chat here.
Oh, you do? Okay. They are not popping up for me, so go for it.
Okay. One
Oh,
question here. Do you see them now, Karen?
I do. I do. Thank you.
Okay, so with a good question here about the deal cycles, with the complexity highlighted, what's the average time to a deal cycle? I try and target, let's see, if I look historically, it's been about 3 months. And I'll tend to reserve about 3 to 4 weeks of that for some heavy diligence before just getting to the term sheet stage. And then from the time of converting a term sheet into a purchase agreement and actually signing and getting through all the legals behind it, that's usually about 2 months. Diligence will, of course, continue during that process there, but it tends to be more confirmatory diligence rather than is this a deal that I want to do? And I know that's always a very hard one, that you'll never have complete information. It's just, are you comfortable enough with the unknowns that you said, all the reasons for me to say no are gone, or I should say, are outweighed by the reasons to say yes.
Okay, and then Josh asked, did you raise external funding for your fund? What was your experience raising funds for this less common strategy?
Yeah. I did raise external funding. So I think as a funding source here, I know that many searchers oftentimes rely on leverage. This is not a thesis you'll be able to raise debt for in advance. I think for a couple of reasons. One, just the tech companies tend to have very light assets, so there's very little to collateralize against. And if you look at the value of technology or the value of human capital, that's a lot harder for a traditional lender to be able to underwrite against. If you do get a deal done, you will fairly easily be able to raise more of venture debt type financing in order to finance a plan going forward, but not to be able to get a deal done. You almost purely will have to rely upon equity. And yes, I've raised external capital for all the deals that I've done, prior fund and this one as well. The question brought up is a very good one. So I'll offer just my overall anecdote here that the world of finance hates diversity. I don't mean that just necessarily in the term of diversity that we think about in terms of ethnic, gender diversity, but anything that's different, anything that's seen as non-standard is considered to be high risk. And I think that's a natural inclination that I can understand. And this being a thesis that is not as popular tends to be not well understood by a traditional search fund investor or even a traditional asset-based loan provider. And I would certainly never try and spend any time trying to convince any of them that this is the right thesis for them. What this thesis is really well for is those who understand venture and those who understand the power law dynamics where there is a lot of money left upon the table. So I think just like the target may be different, but the approach for finding an investor is really the same. Is you're not trying to convince people, you're trying to find people that understand this and understand it well.
Uh, well, it's bound to happen at least once a day that I talk with the mute button on. Uh, what advice do you have for someone who just getting started?
Getting started in general, or getting started on this thesis here, I'd say if you're just getting started into a traditional search fund, I wouldn't look at this thesis here. I would only look at it if this happens to really well fit your, the kind of the Japanese ikigai concept. Like, if you have relevant domain experience in this area, is this something that you love? Do you have the stomach for being able to do some traditional or difficult restructurings? It can be a very lucrative one when you look at the terms that you can negotiate and the valuations you can get for, very, very popular companies. And I think for some, if geography is an issue, the type of target that I look for tends to be in more of an urban environment that may be a little easier for those that are living already in an urban environment to become comfortable with. And certainly, I think it can be a little more appealing to be a part of to be running a hot tech company or something that's in an e-commerce category or enterprise software versus an asset heavy company. Maybe not. But I would say that if you're getting started, only do this if you happen to have a particular aptitude and passion for it.
Yeah, it definitely sounds like one of those things that where it becomes a calling. You have to have the calling for it, both the experience and the desire. So thank you, Jonathan, for this wonderful session and presentation and sharing your knowledge with us. And